Welcome to the London Business School webinar series called Think Big. This is a new series of webinars that we are hosting over the next year or so. And I am Julian Birkinshaw. I am the host of this first webinar. And the series that will come in the next few months will feature some of my colleagues. And what the theme of these webinars is we're going to be looking at big global issues, and we're going to be bringing in experts to talk about those issues. And today we're going to start with a pretty important topic for pretty much any business out there right now, trying to chart a course from disruption to growth, to try to look beyond the pandemic, to figure out what the next few years will bring for us all. And to discuss this topic, we're delighted to have with us two highly successful London Business School alumni. First of all, Nisreen Shocair, who's the Chief Executive of the Middle East region for online fashion retailer YOOX NET-A-PORTER. And secondly, Clare Woodman, who's the Chief Executive of the EMEA region and Chief Executive for Morgan Stanley International. So let me just get a couple of words from each of you to introduce yourselves and your companies. Nisreen, why don't you go first?
Sounds good. Thank you. And thank you for inviting me to be part of this session. My name is Nisreen. I'm currently the CEO for Middle East for YOOX NET-A-PORTER, which is the leading online luxury retailer. And essentially we're part of two different companies, one that focuses on luxury and one that focuses on off-season. So really taking advantage of the full cycle of fashion. Before that, I also worked in retail for the Virgin Group. And then before that in media. So it's as media and fashion have come together, it's been really good to see them, both experiences coming together in such a seamless way.
Perfect. So you're no stranger to disruption. Claire, why don't you say a few words about yourself as well?
Thank you. And Julian, thank you for inviting us today. So I'm Clare Woodman. I am the head of EMEA for Morgan Stanley. In Europe, we're a US a financial services firm, and in Europe we have 9,000 people and we operate in 19 different countries. I didn't start out in banking. I actually started out in the city as a lawyer at Clifford Chance, and decided I wanted to work my way up the food chain and joined one of Clifford Chance's clients, Morgan Stanley. So I've been with Morgan Stanley for 20 years. And I've done a number of roles across the bank, predominantly around our capital markets business. And we have one of the largest equity businesses on the globe. So that's my background. I graduated from London Business School somewhat late, 5 years ago, but thoroughly enjoyed my time. And I can absolutely say that it's really helped inform the way that I manage and lead our organisation in this region.
Perfect. Thanks. And Nisreen, of course, is also an OBS grad from, I think, 2004. So let's get going, and we will start with disruption, and that's probably the hottest business buzzword of the last decade, I'm going to say. I mean, there's a number of others out there, but everybody worries about disruption, and clearly not just the COVID pandemic, but that whole digitization of the world before that. Disruption is something we've been living with for a while. Nisreen, I'm going to go to you first, just because you've got a fascinating background, particularly, I think, in the original period when Bertelsmann, I think it was, who you worked for at the time, got into the sharing of music online, and the whole Napster episode, which many of the people listening will remember.
Let's hope.
Tell us, remind us a little bit about what happened there, because of course Napster were the original kind of disruptors, and it didn't end completely nicely for them. Tell me what your role in that was and what lessons you might have picked up from that period.
Yeah. So speaking of disruption, I'm one of those people who really thrives on disruption, because I'm normally hired to disrupt or to turn around a business that's through disruption, or an industry that's going through disruption. So it works very well for me. when I joined Bertelsmann, we essentially made most of our money printing CDs. And we probably made more money on the physical product than actually the rights of the music and so on. And as things started to change, Napster came on board, 60 million people were actually sharing music and listening to music for free. And we had this idea that, well, that's the future. And therefore, let's go ahead and buy the business. And let's digitize books. We had Random House, let's digitize music, completely not realizing that before you do something like that, as smart as that seemed at the time, if you don't have all the stakeholders in play, then it's going to be explosive and disastrous. And it's self-combusted, basically, because we were trying to charge for it when in fact the price was free. So, and the difference here is this, and it taught me very quickly the difference between the bleeding edge and the leading edge. And we were definitely the bleeding edge. Yeah. The leading edge became Apple Music and Spotify, who benefited from that disruption as labels began to realize that this is here to stay and people aren't going to go back to buying CDs again. But we were sued by every single label, including one of ours, which was ironic. And it cost the business a lot of money. And it cost Napster as well its future, which is very, very unfortunate, because they should have been the winners of this. And in the end, it was Spotify and Apple Music and so many others.
So I do have a follow-up question on that. And I've often wondered about this, right? Which is, back 20 years ago, the music labels, there were 3 or 4, I mean, Bertelsmann, Sony, Warner, EMI, whatever. They owned all the content, right? And yet somehow none of them succeeded in transitioning onto selling this stuff online. And as you say, it was, of course, Napster, then, of course, it was Apple, and then it was Spotify. Why did none of the incumbent companies manage to actually manage that transitional process themselves?
The business model was definitely flawed because they were the publishers as well as the producers. So what meant most of the times is that the artists themselves did not end up making a lot of money unless they were touring, because that was the income they made. Or whether it was merchandising, which obviously now you see a lot of artists have become designers because that's where they realized the money was. But probably it was more than anything, poor management. It was so difficult to convince people who've been doing one thing for 25, 30 years, living a very, very lush, the music industry was a very, very lush industry, parties and limousines outside. And by the way, I worked for all the labels you mentioned, and it was all the same. So they just could not imagine that their lifestyle was going to change ever. And so they fought it rather than joining it. And after that came obviously video, and film didn't learn from it either. So again, other than Netflix, it went through exactly the same thing. And the way they structured the deals, we've got a lawyer as well to tell you that also the royalty rights were so divided. They were so ridiculous. Every country had its own different schemes. And so even trying to put all of that together was so messy that they preferred the status quo until there was no status quo and there was no more business. And then people like Jay-Z and others decided, heck, I'm just going to tour. I'm just going to print T-shirts. I'm going to make, very famous, expensive sneakers, and I'll make a better living. I don't need you.
As you say, the value in that industry has migrated away from the selling of the music, as you say, to the touring rights and the other
selling of their brand. Yeah.
And sorry, Claire, I will get to you in a second, but I've just got one more question just to follow this line, because I'm fascinated by it. History doesn't repeat itself exactly, does it? Because what we're seeing in the movie world right now is, yes, of course, we've got Netflix, but we've also absolutely got Disney, for example, fighting back quite effectively, and Warner and others, who are now vertically integrating forward in order to ensure that they don't actually lose out in that same way, right?
But it's the closed garden concept, and the customer doesn't want a closed garden. They want to be able to choose anything they want from anywhere. And this idea, and by the way, music labels tried to do it. Universal did their own platform. BMG did their own platform. BMG and Sony then ventured together to do their own platform. And then the ones that won were the ones who were Apple Music, i.e. they let everybody choose what they want, or Spotify, who actually encouraged independent artists, and that became even a bigger success. Now Disney's saying, I'm just going to let my customers watch Disney on my channel. And somebody else says, no, just my movies on my channel. That, watch it happen. It will go the same way music went. And for me to watch it happen over and over again, just goes to show you that management does not actually learn from history.
Interesting. So if anyone's watching wants to chip in on that debate, I'd love to hear from you. But look, Claire, we're going to speak now about a completely different industry. I mean, banking is, of course, ripe for destruction by virtue of the fact that banking is almost by definition a digital industry. I mean, money is the ultimate digital product. And yet, compared to the story we've just heard, the big investment banks, the big retail banks, it's the same guys out there running the show as were 20 odd years ago. So do tell us a little bit about how, I mean, Morgan Stanley, probably as well as anybody has navigated this period of huge disruption, the financial crisis, the digital transformation of the industry. What have you done? How have you managed to stay ahead in some ways? Why are the forces perhaps a little bit different than we heard with Nisreen?
Well, I guess we faced, crises and situations which has forced bank management teams actually to have to listen and learn. And I think it's interesting, actually, Julian, if you go back and think, what did the global financial crisis, what positive things came out of that? What came out of that was a banking industry that was much better capitalized, had much better financial resources to deal with, future situations. And so for US banks, and some of them roll forward to, I would say, 2012, and this is relevant to the pandemic. Hurricane Sandy had a pretty big impact on some US banks, including my own's, operations in a particular part of Manhattan. And it caused us and a number of peers to dramatically invest in our technology resources, our desktops, our data centers, and also our just sheer technology capacity to run our plants, which we increased way beyond actually our operating levels. That was absolutely crucial. No one ever predicted the pandemic. Roll forward to that, and then having to get 95% of your workforce to work from home and not in their offices, and actually having good financial resources to be able to support clients and their refinancing needs. So to be able to support clients, also to support our employees, who we absolutely took their health and well-being as the number one priority into the crisis, to get them to be able to be up and running and be able to connect through to their systems in the office and basically operate at home as if they were in their offices was, a huge lift. But I do wonder whether we would have been as well placed to do that had we not made all of the investments and and dealt with Hurricane Sandy in the way that we did. So certainly we have had to take, each crisis to focus on our financial resources, our people resources, and then our operational resilience, completely front to back. And as I look forward now, what I do see as we confront this hugely complex and challenging question of what does return to the workplace in terms of offices as opposed to working from home look like, and the hybrid discussion, I think it puts us in a really good place to try and get the best out of both. And I would say that from the pandemic, what I have seen in our organization is some really interesting changes over such an accelerated time frame in terms of behavioral change, in terms of decision making.
Can I come back to those points?
Yes,
I really do want to get into the micro part of the story, but I don't want to lose the kind of the macro bit. So hold that thought. disruption, I mean, you've done a fascinating story there about how you kind of, found yourself much more resilient perhaps than you would otherwise have been. But when I look at the macro forces around disruption in banking, and I look at blockchain, of course, as a huge force for change, and of course, the whole internet banking thing before, I guess my question is, why has banking as a whole not succumbed to the same, forces that we've seen happening in music, where, for example, outsider companies come in? I mean, is it as simple as regulation, for example? I mean, banking is a heavily regulated industry that must have helped you and others to survive this period. What are the forces for inertia in banking, I guess, is the question I'm trying to get at.
Look, I think I actually think that it's an interesting question, but I think if you look at the asset management industry and the whole retail and wealth industry, actually that's going through a dramatic change as consumers want to be able to do much more on a digital way. It's a very significant generational change in terms of the consumer behaviors. Generations don't want to go into see an advisor and go into a branch. In fact, for the last 14 months, it wasn't always easy to actually go into a bank and do a branch. And so actually being able to provide, digital services to be able to do all of the things that traditionally you would have done by meeting with an advisor or by going into a branch, etc. Consumers want to be able to do on their iPhones, at their desktop, etc. And so I do think there is change. I don't think the regulators have actually perpetuated an oligopoly at all. In fact, they've gone out of their way to create sandboxes and places of, safe and, prudentially safe innovation. And actually, if you look at the retail banking space, there's lots of new entrants and, and disruptors, a number of small banks that are really challenging and pressing, retail banking, etc. So I do think we're definitely seeing, change.
I mean, it is fascinating, and we will move on in a second, but I am conscious that banking is an incredibly resilient industry. You're not wrong. I mean, I know the industry a little bit, and as you say, the regulators are at pains to have, for example, open banking in the UK is a big thing. And yet, the big guys are still sort of more or less keeping the little guys at bay. So it will be interesting to see if that trend continues. I want to shift pace slightly. A lot of people are worried about, how do I do transformation? So, I'll talk to companies all the time about they need to engineer a digital transformation in their company. And here I'm not so much talking about the technology. I mean, Claire, you've talked a lot about that, which was terrific, but almost like the human side of a digital transformation. And indeed, the very first question we received was exactly on this issue of almost what's the human side of digital transformation. Nisreen, do you want to give us some top tips there? In other words, based on your experiences, what you've learned, how would you advise companies to take this whole process of digital transformation seriously from a human perspective?
We came a long way. Initially, digital transformation meant you have a CTO, and the CTO builds an empire, and they buy all kinds of softwares, and they start guiding the company in terms of how the tech transformation is going to happen. And then you have the non-tech people running the business, and then the tech people running another part of the business. Now that's proven not to work. And the idea of a CTO should not exist, or a chief digital officer, let's say, should not exist. Essentially, every person should become a digital officer of their own division, department, at all levels. Yep. That's easier said than done, especially if it's a traditional business trying to become a digital business. So I've experienced that a few times. So again, at Bertelsmann, when I worked there, we had book clubs and music clubs, which were very traditional, and we were trying to make them more digital. You choose everything online, you do everything through the app and so on. And the first thing is, the people who've been working in the legacy business are not ready. They're just not, they believe that that business is never going to move over. So you have a change that's needed. Either people change or they have to leave the company. I know it's harsh, but it's the fastest way forward. And then upskilling the ones that stay to become as digitally savvy as possible and mixing them with digitally native employees. Otherwise, it becomes very, very difficult. So at YOOX Net-A-Porter, we are a tech business, and we generally, there aren't that many tech luxury people you can hire. So you end up hiring people from the fashion industry who worked in stores, worked in physical retail. It's not always easy to move them from physical retail thinking to digital. It's not. But what they need is the tools to do so. That's our job as a company, to be able to do that. What I would say is the worst thing we can possibly do is have two camps, one that's legacy and one that's digital. I did this once in my company where one day I looked at their job descriptions and I added e-commerce to everyone's job description. A third of them resigned. You know, I'm out of here. I wasn't hired to do this. I thought I was doing something good because I'm adding to their capability. I'm making them more marketable in the business, but they weren't ready for it. But the reality is that even if you're running an e-commerce business and you're a buyer, I can't have a buyer who's running e-commerce and a buyer who's running a store. It has to be the same kind of thinking. And that affects your whole supply chain. Because, you know, it's all about assortment. It's all about the number of products that you have. They are the ones who are going to win, and pricing and so on. If you have two different teams, then your site is priced different to your store. It's a different experience altogether. Your supply chain, you're not taking advantage of all your stock that you're buying. So you're left with a lot of overstocks that you're unable to sell at the end of the season. So we've come full circle, I think, from having it being completely separate and costing businesses millions and billions to getting to the point now where we understand efficiency in it becoming integrated.
Thanks. Claire, what's your thoughts on this? I mean, this notion that, you know, you've got to embed digital sort of everywhere and you've got to build everybody's capability. Is that the philosophy you've taken in Morgan Stanley as well?
Well, look, across our institutional and our wealth businesses in the US, you know, technology is vital, and we've constantly always have to, you know, invest in our technology because our systems and our capabilities, and we operate at such fast, you know, execution times, you know, in our trading businesses, that it has to be kind of embedded in everybody's job descriptions, as Nisreen said. But in terms of getting, you know, change affected, I actually think that you really have to figure out, you know, what your clients want, and then you have to understand the culture of your organization. So in some organizations, and Julian, you've referred to this because you've done work on this about digital transformation in banks, and, you know, lots of there's been lots of focus on some firms use, you know, agile teams and it as a way of getting stuff done. And I would say that, you know, over the years, we've tried lots of those different types of techniques to get, you know, change through the organization. And perhaps it hadn't always been well embedded up front when it was started. But last year, when we went into the pandemic, we actually sort of did the Uber agile team in terms of our crisis response team was your best in class, you know, isolated with complete autonomy to make decisions for the organization. And I would say using that agile framework to effect change and transition us to work from home really was an enabler. And I think that model can be replicated if it's, you know, digital transformation that an organization needs to make. But there has to be complete sort of understanding and agreement about, you know, what that's going to do and how empowered those people are in the organization to do that, so that those decisions that they make don't then get, you know, second guessed in different parts of the organization. And of course, the pandemic, no one could negotiate about the pandemic. Everybody had, you know, one clear priority, which was the health and well-being of our people in their minds.
No, I mean, it is fascinating. I mean, we all lived through this in our own organizations, but, you know, the speed with which organizations responded back, you know, roughly a year ago in terms of prioritizing, just as you say, health and well-being of employees, getting customers' needs, short-term needs met.
Absolutely.
You know, the problems of inertia and blockages just disappeared, melted away, and we were able to do amazing things. And of course, that has, I guess both of you, I mean, quick comments on this before we move on, but in terms of, are you finding ways of somehow taking the essence of that new way of working and building it into your way of working going forward? I mean, Claire, I'll go to you first on that one.
Oh, no, you know, absolutely. I mean, we've had, you know, at points in time over the last 14 months, we've had, you know, 95% of our people in this region doing their jobs very well and in a very productive fashion at home. And so, of course, there have been, you know, a ton of learnings in terms of what we can do to enable our people and our employees to maintain productivity. But also to try and work on how do we maintain the social cohesion of the organization, because Morgan Stanley is a social organization where, you know, predominantly the work that we do is done, you know, in offices. And so we are now grappling with the step change of gradually returning to office and enabling, you know, areas where there's flexibility that has actually helped our teams do, you know, a better job by having a mix of in office and work from home. So there are lots of lessons and lots of things that we've taken away from it. And one of the things is, I have to say, is using this sort of technology to use to communicate and to serve a purpose that you may have, you know, historically had, you know, 800 people convened together in a large, you know, location. You may not need to do those sorts of things again. So absolutely, the pandemic has changed learning, networking, you know, interacting, and I'm sure Nisreen can give us lots of, you know, tips around, you know, how to do this, because I think actually, certainly for services industries, you know, the internet and the accessibility and the benefits that the tools can use have really not been leveraged enough.
Good. So Nisreen, let me go to you on that. I mean, we're moving into this question of what is the future of work almost, you know, and clearly an awful lot of people are now saying, well, we're not going back to normal. Normal is now a combination of the old and the new. Hybrid is as good a word as any. Nisreen, has YOOX Net-A-Porter got a sort of formal position on this in terms of, are people being allowed to stay at home? Are they expected to go to a mixture of work and home office? What's the plan, and how are you making the most of the opportunity afforded by?
I think the transition was a lot easier for us because we are a global organization where we operate in many countries. We're a matrix organization. So anyway, we live and talk to people on the screen to begin with. That's how we operated before the pandemic. And we've always had a work from home 2 days a week, which has been always, I would say, ahead of the curve, incredibly civilized for the company, and very, very helpful for the work-life balance. So when it became 5 days a week, it wasn't such a big transition because the technology was already in play. We had state-of-the-art, you know, VPNs, and everybody knew how to connect with one another. We knew how to speak and react to one another by screen, which is, to me, the hardest part. Yeah. However, business aside, and yes, we're all efficient and we're working 10 hours a day and so on, what I do see is a breakdown in team culture that begins to happen. And that's critical for the ones who, the recent joiners especially. They don't get to understand who we are. They don't know the team dynamics. They're getting to know us via screen, no one-to-one interactions. This is going to be setting the stage for them for the many, many years to come in terms of how they interact with us. So coming back to work is essential for them. Plus, not everybody has a country home that they can go to. A lot of our employees probably live in a one-bedroom. they share apartments with a lot of people. So the office was actually a space to rest and relax. Or if it's a mom, she loved being home, but she loved also having that time away to focus. So we found that a lot of young employees were really struggling mentally, putting in place like a buddy system, what we call like walkie-talkies and things like that were really important to keep them close to us from a human perspective. Now, what happens now? We have to come back to the office without a doubt. And what I caution is that it's harder than we might think. So the idea of you just send an email out and say, oh yeah, okay, in 2 weeks, we're all coming back to work. There are a lot of people who have now found out that this is their best way of working, and they're a lot more efficient this way. And it's the new norm for them. And going back to the office seems very abnormal. So we're going to have to, just like we held hands with them being at home, now we have to do it on the other side, getting them back into office mode, working, getting dressed in the morning, wearing your high-heeled shoes again. I mean, we're in the luxury fashion business. It's part of who we are. Yeah.
Okay, so I mean, I've thought about this a lot. I've done some research in this area. I mean, it's often said that the things that the office are good for are the 3 C's, and those 3 C's are culture, collaboration or creativity as sort of part of collaboration, and clients is the third. Now, I don't know if you buy that. I mean, by all means comment, but Claire, let me ask you first of all, what are you doing? What are you trying to do to overcome this culture gap? I mean, Nisreen touched on it already. I mean, it is true that, the bright young things who are joining Morgan Stanley have never been to a Morgan Stanley office. I mean, it's hard to see how they will get acculturated until they're given some sort of, face-to-face exposure. How are you dealing with that?
Well, firstly, I don't think culture is just something that is transmitted physically. I think that actually, and we've worked very hard with, our analyst classes who joined last year to make sure that we did plenty of, online discussions, as Nisreen said, the equivalents of buddy systems and networking events, and plenty of virtual events too. In fact, we went overboard with hosting virtual sessions, etc., to really try and make up for that. And obviously, as certainly in the UK and in continental Europe, as the economies start to come out of lockdown and we can get more people back into the office, we will use that time, as you said, to really focus on those 3 C's, particularly the collaboration, and really focusing on, ensuring that people understand what our core values and what our culture is in terms of how they do their business. But we're very conscious of that. And we are always, when we talk about the business, we talk about clients, we talk about the strategy, Julian, we're talking about our culture at the same time. And James Gorman, our CEO, has been always from day one, but being CEO, really focused on, strategy, leadership and culture, and really embedding those from day one when you join the firm as, a junior analyst. I think as firms and organizations start to think about the transition to more time back in the office. And look, our organization, we've had to have quite a few people performing essential services. None of our offices actually closed during the pandemic. We had to have continuity of our services, but we are actually thinking about the activities and the roles that, people and teams at different layers of the organization and levels of the organization perform, to really think about how do you use, as Nisreen said, that time when you're in the office, and as you said, Julian, to really maximize, your collaboration, cooperation, interactions, and basically replenishing some of that, as one of my colleagues said, relationship capital that is getting a bit depleted, having been, in this very distributed model for so long. And actually, one of the, I think the Linda Grattan's recent piece in other business schools,
You're allowed to mention
how to do hybrid right. actually has a really good framework for organizations thinking through if they haven't started to think through this challenging, because as Nisreen says, it's going to be really complex to return to the office, and it will take time. And I think it will, it won't be a linear, path. It will be, fairly cyclical, because this thing will change, and we're not, quite out of the pandemic. And of course, every country, and Nisreen works for a global organization too, we've all got, we're all operating at different phases. The US is opening up much faster than Europe. And our colleagues in APAC have had a much higher office presence than we have here in Europe.
Yeah, I mean, some of them almost never closed, in fact, which feels strange to us.
That's right. That's right.
That is what happens. So, so look, I've got loads of questions, and we won't get to anything like all of them, but I'm going to ask a bunch of them in a second. But we've got one final question I want to ask both of you about before we move to audience questions. Looking to the future, I mean, this is a session about, from disruption to growth. I mean, by all means, answer it how you see fit, but certainly one huge trend, one huge opportunity / threat is the whole sustainability agenda. In other words, the extent to which our own organizations are able to play a sensible part in that collective global effort that's needed. Can I get each of you to share some of the things that you're doing in terms of sustainability? I guess I'll go to Nisreen first, and then I'll go back to
Sure. So sustainability has actually been part of our DNA for a very, very long time. It's why YOOX got started in the first place. And then Net-A-Porter has had Net Sustain for probably almost 8 years now, and it's one of our most popular franchises and continues to grow. What I find fascinating is how the Middle East has become much more interested in sustainability than any other factor. So when the youth, and they're 70% of the population, were asked, why would you shop with an e-tailer or retailer? There are many reasons: assortment, price, etc. And the number one reason was sustainability. And they can, because they're young, they're smart, they can read right through fake, messages that are just done for CSR purposes, or when you're authentically building a sustainable brand. Also working very, very closely with designers who are using reusable materials, like Gabriella Hurst, who now is the creative director of Chloe, who uses recycled cashmere, on the very, very high end, but also on the entry level. We're finding many, many opportunities to do that. We have councils, we have a program called Infinity. It's a personal commitment that every member of YNAP has to commit to in terms of their everyday job. And nothing brings me more happiness than to see this in the mainstream retail business than anything else. It's something I've been advocating forever. When I was with Virgin, I was invited to join Richard on stage to talk about disruption in retail, and I was talking about unconsumption. Someone said, I'm never ever going to get a job in retail again. That, how could you advocate unconsumption? And what I was saying was, globally, we have enough of what we need, and we should invest in pieces rather than doing the dollar stores, because essentially somebody's paying. If you only pay $1 for something, somebody else is paying more than $1. It could be with their losing an arm or a finger. It could be losing an education if you're young. It could be losing your eyesight if you're doing, small network. Somebody's paying for it one way or the other. If it's not dollars, it's in health. So we all have a role to play, and it's nice to be working for an organization that takes it very, very seriously.
Thanks, Claire. Because obviously banking's a very, very different sector in regard to this, but I think you've still got quite a story to tell here, right?
Oh, totally. I mean, look, ESG investing is mainstream finance now. And actually, I was just looking down because I wanted to make sure I got the figure right. The global flows into ESG funds in December reached record highs last year of $62 billion. I mean, over the past 5 years, you know, ESG investing has really, you know, accelerated in growth. But for us, you know, like Nisreen's organization, we recognize the risks posed by global sustainability, you know, including climate change and, you know, inequality and the impact on communities, you know, over a decade, you know, long time ago. And we set ourselves, you know, throughout the last decade, various targets and commitments that we would stand by. And in 2018, we made a significant commitment to finance over $250 billion of, you know, low carbon solutions for clients in terms of, you know, clean technology and financing, you know, renewable energy, alternative sources of energy, sustainable bonds, you know, and transactions that would facilitate, you know, the transition to a low carbon economy. Last month, we announced that we would triple that commitment to $750 billion. And that's made in part of a, you know, a much larger commitment to really, you know, mobilize and drive sustainability. But in terms of coming back to, you know, strategy and culture, how did we get our organization behind that? You know, we're a traditional US investment bank. It was all about, you know, really actually not having a silo. And Nisreen talked earlier about, you know, it doesn't work if you have a chief technology officer that just sits in one silo. You know, these changes in organizations have to be across each and have to be very horizontal, not vertical. And certainly what we did was embed, you know, ESG and sustainability across not just our own operations and remove single-use plastics from all our buildings, but also really ensure that we were providing best-in-class advice, research analytics, really work on the transparency and the comparability of companies' data. And Nisreen was, you know, alluding to, you know, greenwashing. Well, we're really working to help the industry, you know, come up with good metrics and good data that enables you to compare the journey that, you know, companies are making as they, you know, transition their organizations to lower carbon environments.
Is it the case in banking? I actually have no idea what the answer to this is. That you're getting the banks who have made a, you know, a credible commitment to sustainable investing, sustainable finance, etc., are actually getting a premium on their share price, or not. And because if I look, for example, at the energy industry, I can see clear evidence that the companies who have put, you know, full commitment to renewables are actually getting a return on that, Iberdrola and Enel and so forth, compared to Exxon, let's say. What's happening in the banking sector? Do you monitor that?
So look, our research, absolutely, we look at different data sets of corporates, and what we have seen is certainly in the world of funds, sustainable funds have achieved over 2020 better returns than their traditional peers. Now, you might say that 2020 was kind of the year of, you know, sustainability and a wake-up call to ESG, but actually when we look at, you know, a longer term time horizon, we see that actually there's lower risk, there's reduced costs, and there's, you know, the opportunity set for companies to drive higher returns. And you are seeing that, you know, coming through and translating to, you know, better pricing in terms of, you know, the financing that's available. So the change is happening, and we're absolutely seeing that for sure.
Got it. So lots of questions, as I say, and I'm going to bounce around a bit. I'm just going to try to pick up on some of the ones which I think are kind of interesting. Somebody asked, and this is for Nisreen, asks about consumer behavior, and I guess an interest in trying to tap into the differences in consumer behavior across the different parts of the Middle Eastern market that you're you're selling into, and of course, looking across the whole range of the different fashion items. I don't know quite what's underneath this question, but can you give us a flavour, because this is an industry I have no personal knowledge of in terms of how people buy fashion online. Can you just?
Well, I mean, we never could have expected what people were going to do online in a pandemic when they weren't going out. But what was really strange is they were buying a lot of bags and shoes. So, and we heard that from all retailers, and they were buying jewelry, and they were buying beauty is an obvious one. There was a lot of focus on skincare and, you know, masks and things that they were doing at home. But what was very surprising for me is shoes. You know, we had nowhere to go, yet people were buying shoes, and very, very flashy shoes. So to me, what is very, very obvious is optimism. You know, it's a classic case of being very, very excited and feeling like, you know, we're coming out of this lockdown soon. The other thing I would say is, and actually it's an either or spectrum. So it's either very high spending, or what you would call revenge spending, and this is just the industry in general, or you're seeing people who are very, very promotionally driven, smart promotionally driven. You know, they want good brands at the right price, and they're willing to wait. So those trends we're definitely seeing, and they're global trends. It's not just us. You heard a lot of people say tops were selling more because of Zoom and so on. We've seen really strange, you know, behaviors like, why would you buy a bag? Why would you buy a pair of shoes when you're not going anywhere? Yeah. You know, but to me, those were all good signs. You know, we were selling really expensive evening gowns. And wow. So people were definitely preparing for when we'll open again. Those are good signs, very, very good signs. The Middle Eastern customer is really unfazed. She's a beautiful, amazing customer.
Well, I must admit, I do not recognize any of what you just said.
Julian, everyone's preparing for the roaring 20s, you see.
I guess that's right.
Absolutely.
You know, I don't know when I last wore a tie, let alone bought a tie, for example. I'm going to take a completely different line now, unless Claire wants to speak to what Nisreen just said. But Claire, there was a question about digital currencies from central banks. I mean, that might be a little bit techie, but you know, we do see a lot of central banks now talking about launching their own digital currencies. We central banks, of course, looking very closely at the potential of blockchain technology. Do you want to just give us a quick sense of what the issue there is?
Yeah, look, most central banks are looking at digital currencies and some form of currency. I think I would differentiate those from you know, Bitcoin and other currencies, in that I think there's an intention that they will be backed by, you know, fiat currency, etc. But absolutely, I mean, I think most central banks are really looking at the benefits and the tools of, and you referred to blockchain technology and distributed ledgers. And, you know, can these be informative? Are they helpful? So yes, absolutely. The ECB, the bank, and more recently, the Federal Reserve have all said that they are looking at digital currencies. So let's see what happens.
Indeed.
In that space.
Well, this is it, because obviously, if you're a central banker, you are extremely nervous about this concept of a sort of a completely deregulated banking system. So, and look, I can absolutely see why we'll see some sort of hybrid thing where the central banks are maintaining some sort of control but making use of the technology. Here's a difficult question, and it's a guy called Don, and he says, you know, the metrics that you monitor in order to ensure that you don't get disrupted. In other words, as you look at the disruptive forces out there, the big challenge you always face is when should we move? In other words, take blockchain as a great example, but it's not the only one. You know, at what point do you jump into blockchain? It's quite possible to get in too late. It's also possible to get in way too early. So this doesn't have to be about blockchain. It can be about any of those forces for change. But how do you monitor the new things that are bubbling along in order to make sure that you catch the right wave at the right time? as I
Maybe
say,
I can talk. Maybe I can talk about that a little bit. I mean, studying a lot of, and we did that a lot, London Business School, where you study a lot of businesses that, had their heyday and then collapsed. And why did that happen? And across the board, it's always because when a company is doing very well, it starts pulling dividends, stock prices go up, your shareholders want a better price and so on. And the investment in what's next is less and less, unless you have a visionary leader who's always assuming that disruption is there and it's bubbling. And I'd rather create it before someone else does. I mean, the Walmart Amazon example is the best one possible, where, Walmart is a, Fortune 1 company. No one could go near them. They had a mega store in every little town in America. They owned America. They owned factories. They owned everything. And one day, Jeff Bezos came up with books, and then here we go. Now, when they tried to go back in and invest, as Doug McMillan started doing in the last 3 years, it's too late. It's too late. They should have done that 10, 15 years ago. But they couldn't, because the leadership was old school and probably thought, oh, who's this Jeff Bezos guy? He'll never make it. But any business we're in, when we're doing our best, is when we expect that someone's going to be looking at us thinking, I can do this better, or I can do just the same. So that's when you need to invest.
Claire, what do you think? I mean, in terms of monitoring current potentially disruptive trends?
Yeah, no, look, I think last year was quite a sort of an execution year and a conclusion of some of our transformation. And Julian, as we talked before, we made 2 acquisitions last year in the US. One was we bought a very large online brokerage firm, E-Trade, which we are integrating, and a fund manager, Eaton Vance. And both of those acquisitions were as a consequence of recognizing that we wanted to diversify and complement some of our existing businesses, particularly in the wealth and asset management space in the US, where we knew that we had particular gaps. And so I think part of the answer to your question is, as you're constantly reevaluating where you are on your strategic journey, you're evaluating, can you grow organically in places where you've got gaps, or where actually it makes much better sense to acquire and inorganically grow that more quickly and gain true scale. And that's had a significant impact on the size of our business and our footprint in the US. And so that really has complemented all of the services and that we can provide, certainly on the wealth and asset management space. And then when we turn to our institutional businesses, we're constantly thinking about where potentially are there disruptive forces, where are there areas where we have to keep investing in terms of remaining best in class in terms of the technology and the services and the capabilities that we can provide. And so some of it is about metrics, but also I think it's about stress testing, and basically it's that you taught us this at business school, horizon scanning and looking around corners. And that's quite hard to do, but it's absolutely necessary in terms of understanding the landscape. And I guess for Nisreen, this whole growth in sort of recycling, reselling, and sort of this upcycling in terms of in the retail sector has been her company's been front and foremost at that.
Thanks.
One thing I was going to add as well with Richard Branson, one thing he taught us is this idea of always saying yes. Because when Airbnb first started, they probably went to a hotel chain. And when Uber first started, they probably went to a big car manufacturer. A lot of those disruptive businesses at one point pitched to the large organizations who said, terrible idea, look at what they were wearing, probably walked in with jeans, a little bit unprepared. And the answer was no. Yeah. And a lot of those businesses came our way and we said no. So learning from those experiences at Virgin and other companies is always say yes. You never know. Those two kids who are going to walk through the door and give you this crazy idea might in fact become your biggest disruptor just a couple of years later.
Well, it's an established fact, isn't it, that Netflix tried to sell themselves to Blockbuster. I think it was 2002.
Yeah.
Said no. Okay, we're running out of time. I've got two more questions. One, if you can answer quickly, that would be great. What should we do with the older generation, somebody says? I don't know quite what the older generation is, but perhaps it's always somebody who's older than you, isn't it? So maybe it's not the people who grew up with technology. I guess it's the old baby boomers, of which I'm kind of the last year. Can we train these people up to make them digitally savvy? Should we just give them traditional jobs in the back office or to servicing equally old clients? Sorry, I'm being deliberately politically incorrect here, but
yeah, no, I'm gonna take that because I'm definitely against age discrimination. I believe it's attitude, not age, and I've seen it. I've seen very young people who are very, very resistant to change, and I've seen people at, it's hard to even say older, but very, very open to different ideas, willing to learn, willing to adopt new technologies, and they train themselves. So they don't even need like special programs or internships or anything like that. What's probably more important is establishing what I would call returnships, because more than ever, as the retirement age is getting older and older, especially in the UK, there is this period of time where people are feeling poorer and poorer as they get older. So actually, I think companies have a responsibility to bring them back and do returnships into the business. So that's probably very effective to keep them feeling valuable.
Claire, any quick thoughts on that before my final question?
Yeah, learn from them and agree with Nisreen. We had a return to work program years ago that started out to help women who'd actually taken, a period of time out of the organisation and financial services. Actually, it's not just for women who are and mothers who are returning to the workplace. It's broader than that. So they can be really successful programs for organisations.
Thanks. And I've had several of these questions, so I'm going to ask one of them. You have two incredible women leaders on the panel today. What advice would you give to other women sailing through disruption? And you can take this in whatever direction you want, but you're going to have to be pretty quick because we're going to finish this thing up in 2 minutes. Any quick thoughts on being a female leader in today's?
I'm going to give it to Claire because she's a woman in a financial institution. So Claire, go ahead.
Keep up your network, stick with it, and develop your own board of directors to give you support and reciprocate. So it's incumbent on all of us to bring others through the organisations that we run. So that would be my tips.
Do you want to add anything? Or
I'd say definitely, if you feel like you don't have a skill, get it. In my case, I felt that I was missing some financial skills. I went and got an MBA and I focused my courses on finance. That was really important. And then I knew that I was good at turnarounds. I loved messy things. I loved to clean up messy things. And I was good with people. So the best advice I would say is know yourself and apply yourself in industries where you feel you can be the most successful, and forget about glass ceilings and all that equal pay. Just focus on what you do best.
Perfect. And indeed, London Business School does have a very successful Women in Leadership Executive Education program, which if any of you are interested, I'd be very happy to provide more information about it. So a nice opportunity for a plug for one of our programs there. We are going to wrap up there. Thank you so much, Nisreen. Thank you, Claire. Fascinating conversation. Obviously, we covered a huge number of issues, and we only really scratched the surfaces of the questions. We're going to make this a video available for anybody who signed up, and obviously anyone who's listening, please watch out for future announcements. If you've given us your information so we can get hold of you, we will keep you updated on all our future events. So without any further ado, I'm going to call proceedings to a halt. Thank you very much for listening. Thank you for joining us, and have a good rest of your day. Thank you very much.